There's one trading strategy I use every single day. It's stupid simple, insanely reliable, and it's the reason I make consistent profits in the market day in and day out. 95% of the traders completely ignore this one candle that could change their entire trading career. And the best part about it is that even a complete beginner cannot mess this up. Now, when you start learning about trading, you hear a lot of terms like double top, double bottom. So you'll have some sort of patterns being formed within the market that pattern traders say. You have doji candles as well that are very, very famous within the market. You have engulfing patterns, then you have supply and demand or support and resistance. Then you also have order blocks, and then you finally have smart money concepts. And yes, all of these can work, but they're also very, very subjective, because you can give two traders the same chart. One will say this is a buy and the other will say that's a sell. So what's really happening? The truth is, most traders are focused on what they see, not why it is happening. They react to patterns without understanding the purpose behind it, because behind every single pattern there's an intent, the reason price is moving that way. And there's one candle that exposes the intent. It's the candle that shows you where the retail gets trapped and where institutions take control. And that candle is basically called the inducement candle. And once you understand it, everything on your chart starts to make sense. Now, before I break this down, if you're serious about learning how to think like a professional trader and stop reacting to price and start understanding why it moves, then book your free one-on-one call using the link in the description below. Now, what is an inducement candle? Here's the simplest way to understand it. Imagine price is sitting right below a major high. So price can be tapping into a resistance zone or a supply zone. As soon as the price taps into it, support and resistance traders, they start piling up their sale position, putting their stop losses at this high or even at a price point above this major high. Then out of nowhere, one strong bullish candle forms. It breaks the high with force, and all the breakout traders start thinking that maybe price is actually creating higher highs and higher lows. So what they do is they start piling up the stop losses right below this price point. But just moments later, what the price does is it starts to reverse. Price reverses and creates a bearish displacement candle. That there is your inducement candle. It's the candle that basically grabs liquidity and shifts direction. It's not random, it's engineered. That single candle is where liquidity is collected from retail traders, their pending orders are filled, and then moves the market the other way. So this big bearish candle is the inducement candle. Spotting a true inducement isn't about guessing. It's about reading the sequence that happens in the same order. Here is what to look for, the 5-step structure every real inducement follows. So the first part of the cycle is liquidity. It can come in a form of equal highs. It can also be equal lows. It can also be in a range. And this is where basically you have all the stop losses resting. Then comes the sharp moves that sweeps all the stop losses that were resting above this price point of all the traders that got into a sell position from 1 touch, 2 touch, 3 touch. And this also provided an opportunity for the breakout traders to get into some sort of buys, and their stop losses are basically resting at a price point here. They could also be resting at this low. Right after this inducement, you'll see a rejection, and the rejection in this case would be in a form of a strong bearish candle. That's your clue that liquidity has been collected, but that alone is still not enough for you to enter. What you want to see next is basically price giving you a relevant breaker structure. So you'll see displacement happening to the downside, an aggressive move that leaves behind imbalances, and it also shows you a bearish intent by giving you a bearish breaker structure. And finally, after the breaker structure, price returns back to the imbalances or the mitigation zone to retest it. That's where your refined entries come in. That's the point where the market confirms the trap and continues in the new direction. So remember the sequence: liquidity, inducement, rejection, breaker structure, and finally mitigation for you to enter for a trade. That's not random movement, that's the entire life cycle of a trap turning into a trend. Now, if this is happening on a higher time frame or middle time frame, the pullback into the zone after the break of structure can be used as a point of interest to look for lower time frame confirmations. However, If you see this happening on your lower time frame, on the time frame that you usually take trades on, then it becomes your entry model. Now, before I jump onto the charts to apply what we've covered so far, there's a very common misconception about smart money concept sweep and inducement, because when you look at them, they look similar because both grab liquidity. So if you look at it from the eyes of a smart money trader, you will see this as equal high, price goes up, sweeps this liquidity, and someone who trades an inducement candle will look at it the same way. You have equal highs, price goes up, sweeps liquidity as well. And they both seem to reverse as well, give a reaction. You will have some sort of a reaction being given within the price. But they're both not the same thing, because a smart money sweep is just the market taking the stop losses that were resting above this high, and after that it sometimes reverses and sometimes it just keeps going higher, keeps pushing the price higher to create higher highs and higher lows. So this here, you could class it as just a reaction. However, a true displacement on the other hand means that market actually uses this liquidity to shift direction. It's not just a stop hunt, but also the change in market sentiment. So here's the simple difference. A sweep of the liquidity in both the cases only shows where the liquidity is resting. A true displacement to the downside actually shows what the market did with it. After the true displacement, you will see bearish breakout structures being given within the price. This confirms that it was just not a trick, it was actually the start of a new move. So next time you see a sweep, don't assume it's a reversal. Ask yourself, did control of buyers to sellers or sellers to buyers actually shift here? That's how you filter fake setups from real opportunities. So next time you see that one candle, don't react to it, read it, because that single move shows you where the entire market shift happens. It's not random, it's engineered. Once you understand inducement, every single setup, every pattern, every move on your chart starts to make sense. That's the difference between guessing and knowing, between reacting like a retail trader and trading with intention. And if you want to go deeper to actually see how this plays out live, step by step, that's exactly what I teach inside my program. I break down live market price action, and the best part is you'll be part of a community of traders who are already applying this and seeing consistent results. Let's hop onto the charts and apply what we've learned so far. Now this is GU 3-minute time frame. What you can see here is this is the start of a New York session. So what the price did basically before New York kicked in was it created some sort of a trend line. It created this liquidity. Before New York opened, price went down, induced that liquidity, and then give you a relevant breakout structure through these big bullish candles. Once that bullish intent was seen through the breakout structure, through these bullish candles, all you had to do was wait for the price to come back down into some sort of imbalance, some sort of fair value gap being inversed, and that was your cue to actually enter the trade and use that as a point of interest. And you could have gone down the time frame on M1 and looked for another confirmation to enter the trade. And you know what? We'll just keep looking at the price action through this lens. Price did a similar thing in the next session as well. What it did was it created some sort of a trend line. London session open, went higher, induced that liquidity, and gave you the relevant breakout structure. Now what happened was this big bearish candle was the one that was the inducement candle, because this is the candle that shows intent, shows the rejection, shows the reaction, and shows the reversal as well. Then all you had to do is wait for the price to return back into some sort of point of interest. In this case, that point of interest was this imbalance. Wait for the price to make a reversal into it, and then you could have either entered on this time frame or go down the time frame on M1 and look for another entry model using this zone as your point of interest. Now moving on to the next session, which was the New York session, you had price creating relatively equal highs here. What the price did at New York open, went higher, induced it, tapped into some sort of imbalance, good objective taken, and price then reversed. It reversed, showed you bearish intent through the breakout structure. Now once price give you a breakout structure through this candle here, all you had to do was wait for the price to make a pullback into some sort of an imbalance. In this case, this is the one that we're utilizing, and you could have entered for a sell position at this price point here. And we can see this inducement candle form time and time again. So what happens next is This is still the same day, a couple of hours after New York open. So we had more liquidity in a form of a trend line. So you had this bullish trend line. What the price did was came down, induced that liquidity, and gave you the breaker structure at this point. Now all you had to do was wait for the price to make a bit of a pullback. You had plenty of POIs. You had this imbalance here, this one here as well. So you could have waited for price to tap into either one of them, and you could have entered for some sort of buys. Let's look at the very next day. So what happens here is that is the start of your London session. Again, price creating some sort of liquidity prior to your session time, and this is why the time factor is very, very important. You can see a lot of inducements happening outside of your trading window, but that's not your window to trade. So you're not going to actually put any trades in. Even if you see some sort of liquidity being induced and a reaction given, that is just not your window to trade. So in this case, coming back to this, we had a bearish trend line. Price goes higher, induces that liquidity, and then it gives you this breaker structure here. And then all you had to do was wait for the price to make a bit of a pullback. We had a couple of points of interest the price could potentially tap into. We had this imbalance, we had another one, we also had this efficiency point, which is ideally the most relevant one in terms of a pullback. We wait for the price to tap into that, and then we go for sales. And this here again, basically the one that shows you a bit of a bearish intent is your inducement candle. And in the very next session, what basically happens is we have another trend line, price goes higher, induces that trend line, and gives you the relevant breaker structure. Now in this case, all you have to do again is wait for the price to make a pullback into some sort of point of interest. A lot of imbalances left behind in this case here. You could have waited for the price to tap into that, and you could have gotten into some sort of sell position. And now I can keep on going and show you that there is multiple inducements, multiple times that this inducement candle actually forms, but this is enough for you right now to look at the price through the lens of inducements. And frankly speaking, this is an everyday story. You can spot and trade the inducement candle when the time is right, when the type of liquidity induced is strong, and the reaction is given. So if this video made something click for you, don't stop here. Rewatch it, mark your charts, study the 5-step sequence: liquidity, inducement, rejection, breaker structure, and mitigation, until it becomes second nature. Because this isn't just one candle strategy. It is the blueprint behind every engineered move within the market. And once you see it, you'll never look at the price the same way again. And as always, thank you. And make sure you're subscribed, because I'll keep dropping more content that actually helps you grow as a trader.